Today we would like you to submit the monetary policy outlook, and the central bank's board will be represented by a member of the board, Armen Katoyan. Mr. Vazgen Povosyan will lay down the outlook, the head of the monetary policy department, and the same department, macroeconomic policy expert Heike Valentine, has joined us today. After the keynote, you can introduce yourself and ask questions. Thank you, dear colleagues, for joining this. As you know, yesterday at the 16th of June board meeting, the central bank let the 6.5% refinancing rate unchanged, and as a rule, in the wake of that announcement, we have tri-monthly meeting with analysts. I will submit to you the main scenarios and judgment behind this decision, a substantial analysis that took place at the board. The slideshow embodies the final opinion of the board deliberations. So this was presented to the board, and we share it with you as well. I'll start with traditional external sector and the US economy. In conditions of high uncertainty and since last year there was a policy change in the United States, you name it. And there are certain one-off factors. If you remember, in Q4 25, there was a shutdown of the cabinet. Then it was reopened. There was certain volatility in GDP. The volatility is still quite high in the economic growth in view of these factors, but in general terms, the main trend in the American economy is still certain weakening of the economic growth. As Q1, we see that the economy has weakened and got closer to a more balanced growth level. On the other hand, when we look at the consumption rates have also slackened, but it's still the major incentive for economic growth, and it continues to contribute to high prices of financial assets in the US. In the right-hand graph, within the last year, over Q1 previous year, this year, there is about $13 trillion financial assets increase in prices. It's about 1/3 of the GDP. But here again, there are risks. There are certain signals that attest to the fact that the financial assets are pretty overpriced in the American economy, and there is risks of adjustments that may push it downwards, weakening the economy. These are the signals that I mentioned about the economy getting to a more balanced growth. This is also attested to by the labor market developments in the United States. The unemployment stabilizes at between 4 and 4.5%, and the wages growth also weakens and stabilizes more. Let's put it this way, closer to the productivity and expected. Inflation 3.5–4%. That is essentially there are no major inflationary pressures on the economy transmitted. Although the new jobs have grown within the recent years to some extent, there are one-off factors there as well. You know, it's the World Cup held in the United States, and hospitality, entertainment, catering created lots of jobs within recent months. Let's see what would happen to these new jobs in the wake of the World Cup, whether it will come down or will remain high. So, in general terms, the American economy is more in sync with a more balanced position. On the other hand, there are certain risks still in the Middle East developments. Although we saw in recent days certain optimism came about regulation, an agreement is expected, but within the several last months the uncertainty was quite high, and the oil prices and its volatility usually have a negative impact both on the investments, on consumption, confidence in the future as well is eroded. Although to this point we've seen that there were no significant adjustments in the consumption behavior of the households. In the lower right hand chart is the level of savings of households, disposable income that is, but the rising oil prices and food prices have absorbed the savings. The level of savings has dropped somewhat, but since this conflict lasted quite a while and the prices were high for quite a while, on the other hand, consumer confidence in the future has weakened. In the top right chart, this is historic low for America. And all of these signals may prove that on this side there is adjustment, or there are risks of adjustment of consumption in the United States. On the other hand, if we look at the rising risks, long-term interest rate or the neutral rates growth or higher level risks staying longer. On the right hand top chart, it's the net income from tariffs, net revenue from tariffs. You know, by a ruling of the Supreme Court, some of those duties were capped and their collection restricted, and the government was made to return some of the collected duties in response to the application of economic agents. So in May, the net income from customs duties is in the negative. In the past, there was $25 billion collected. Now it's in the negative. Let's see how it goes. It's more important that for the next 10 years, the planned budget had increased expenditures, hoping that there would be revenues increasing on the expense of customs duties. So on the one hand, they're restricting collection, on the other hand, their commitments in expenditures already made. This may deteriorate the state of the budget. The risks also remain about the Middle Eastern developments, increasing defense expenditures, and most probably they're headed that way. This may erode or jeopardize fiscal stability. Another risk in the lower right chart, in the recent years when the interest rates were quite high, the government has shifted to issuing short paper, and this is within the next year the debt that has to be paid or reissued. It has gotten to more than 8 trillion. So the debt that has to be paid within the next year, if the interest remains high, there is a rollover risk increasing, which may be charged by the market. So the long-term interest within the recent years have also increased and are pretty high level. The 10-year is 4.5 and slightly 30-year is around 5%. In this situation, considering also inflationary environment expanding, the Federal Reserve System is facing quite difficult challenges. Their double mandate has to be effectively managed, inflation and employment. The inflationary environment continues to expand, but then there is more fundamental components, sticky prices, inflation, core inflation. They're still around 3%, have been for quite a while, and the new inflationary wave may have a larger impact on this. The markets are already reviewing their expectations about the Fed policy. If you look at the blue curve in the right chart, prior to the Middle Eastern conflict, they were expecting 3.5 to gradually go down to 3 over the year and stabilizing at that level. Now the markets expect more increase from the Fed up to approximately 4%. Staying there, give or take. The expectations about the Fed interest rates have increased. We'll keep monitoring. I think their announcement is due today. The markets expected would be unchanged. The EU economy also, in view of the high uncertainty environment, continues to weaken, but the EU economy is dominant with replete structural issues that have been observed for quite a long and are deepening essentially in Q1. In the EU economy, there was economic decline 0.2% Q over Q. In the right-hand chart, this economic downturn is mostly determined by just Irish economy, which had a 12% fall in Q1. You know the specifics of Irish economy. There are major multinationals incorporated Ray, and they've reoriented financial flows out of Ireland, so it's quite volatile. But even if we ignore the Irish economy, the growth is very weak, hovering over zero. If we look at the country breakdown, the structure of that growth within the recent months in the right-hand chart, it's more ubiquitous, the weakening of the growth. In France, it's going south. In Sweden, for example, and other countries as well, there is weakening. There are signals of subsequent weakening by PMIs. The services PMI is in the negative, which is a signal of subsequent demand for weakening as well. On the other hand, the inflationary environment keeps on expanding in the EU. In February, it was 1.7 inflation. As a result of high fuel costs, the inflation has accelerated, and it's hovering about 3.2% as of May. They essentially are more vulnerable to fuel prices and supplies, both oil and this particular natural gas. Their stock within the recent years is at the minimal in the historic context, so we need to consider that although in the EU the core inflation was early this year forming around the target, but the services and sticky prices were also high, and that's their main challenge essentially if the inflationary environment keeps on expanding, there may be risks about price stability. The ECB, in their recent June statement, increased by quarter of a percentage points the interest, and the markets expect this increased policy staying on. For the current year, about the policy rate will is already quoted in the market by one notch. Russian economy developments, they're quite interesting ones observed in there. What's the biggest uncertainty about the Russian economy? It's their growth potential or long-term sustainable development level uncertainty. The Russian economy, long-term growth rate level. For example, the Central Bank of Russia provides 1.5 to 2.5 long-term sustainable growth, and the Ministry of Economy quotes 2.4. The survey by the Bank of Russia about the financial markets, the financial market respond about 1.8. So the total assessment is between 1.5 and 2.5. But the question we are asking is whether there may be scenarios out there in the case of which the Russian potential growth may be close to 0 or 0.5 or below 1. And this is about the current growth, which in Q1 was negative, about 0.2%, minus 0.2%. There are one-off factors, of course, that contributed to it. Weather resulted in weaker construction. But even considering these temporary factors, they may have close to 0 or 0.5 growth in Q1. Their main challenge is, or the potential policy error may be, that if they estimate, for example, the potential economic growth would be too high, and that these low levels are cyclical, and the economic policy would be more incentivizing the economy to restore the growth. This may result in structural issues accumulating and deepening with the subsequent adjustment possibilities. We, of course, do not rule out the possibility that these low growths are cyclic and will get back to more stable levels. There are several things that we would like to demonstrate here as well. The growth at this point, like I said, has been low in Q1. We will still reflect on Q2 developments, and there were certain signals attesting to the fact that the Russian economy accumulates and deepens structural issues. The left-hand chart is the NPL weight in the consumer loans portfolio, which are growing within the recent period with high rates, getting at high levels. On the right-hand chart is the developments in the real estate market, which prove that the number of transactions is here. In the primary market, it's in the negative. In the secondary market, it entered a small positive, but over a certain period of last year, it's dipped down. So both the transactions prove that the market is weak. And if we look at other factors, there are interesting developments. We looked at their sectoral receivables. and we see that there is serious issue of collection. Receivables are accumulating, the companies owe each other and whatnot. So the structural issues in the economy are observable. On the other hand, especially within the recent months, March, April, May, there has been certain activity observed, acceleration in the economy. The left-hand side chart is their monthly economic growth, especially in services and retail. There is certain growth observed, which is in tune with the right-hand chart. Imports increase within the recent months 15-20%. This is incentivized by the fiscal policy significantly. This is about what I said. The fiscal position is quite incentivizing. If you look at the left-hand chart for the year, they had planned 3.8 trillion rubles of deficit, but January to April they already have 5.9 trillion budget deficit. So essentially, especially this year, it was a major incentive. The right-hand chart shows cumulative development last year. This year's dynamic is deeper than last year's development. If they planned for a year 2.45% deficit, as of this point in time, it's much more deeper. We'll see how the developments unfold through the rest of the year to understand where it ends up. The labor market developments are in tune with the other developments. It's the growth of wages. Real wages growth has accelerated within the last 3 months. Is about 7-8%. And it's proliferant, it's not centralized, focused on one or two sectors, it's general. So the acceleration of the economy is observed within the last several months, but the major problem is how stable is this signal, or is it just the impact of incentives on maybe short term? And on the other hand, we see structural issues that are accumulating in the economy. In these conditions, considering also the inflationary environment developments, they have interesting developments here. The inflation continues to go down. 12-month inflation is around 5%, getting close to it. But this is mostly determined by more flexible components of inflation, whereas the services inflation is even accelerating. It's around 10% at this point in time. And the inflationary expectations also continue to remain quite high. In these conditions, the financial markets expect from the Russian central bank a more cautionary and gradual lowering of the policy rate compared to the previously declared. Commodity markets, we have to say, notwithstanding, you are aware of the most recent developments. There is quite a big probability or chances of normalizing the conflict, but until last week the developments indicated that the oil price on the left-hand chart is the International Energy Organization forecast. They reviewed it upwards every month, the oil prices. And if you look at the food market, the growth is there in the right hand chart. The blue curve represents the acceleration of this index within the last month. These have certain inflationary influence on our economy, and it was only partially reflected in our economy. They're not yet reflected fully in our local prices, but on the other hand, the curve of these prices is replete with uncertainty, especially with respect to oil. It is hinged on both the regulation or conditions of normalizing the conflict, or even provided it's normalized, will the supply be fully restored, because there is extraction volumes have gone down, certain wells have been closed, and the reopening will take quite a long time. There are other supply issues, so this market, to expect full back to normal in this market may be somewhat risky. But on the other hand, there are scenarios that in these conditions, in some countries, the UAE left OPEC, and the commitments they had assumed about volumes of extraction, there are no more caps on it for UAE. Other countries, the US is increasing the volumes rapidly, and if Iran restrictions are lifted, there are scenarios that the supply of oil may expand much more, and the prices may end up quite lower than before. As for domestic economy developments, if we start with the risk premium, we see that on the left hand side is our risk premium assessment, which has been done on the basis of our euro bonds maturity dates, about with the spreads on non-risk bearing assets. The spread continues to shrink on this little yellow curve on the left hand chart. It's around 160, 170 base points, which is historic low for us. A year ago, about the same period, it was 300 base points that our spreads came about. This is uncertainty around this is quite high again, because the extent to which it is cyclic, or the extent to which it is determined by global markets liquidity level, which is high, or increasing overall, improving overall sentiment about developing economies, or some indigenous factors for this country, or improvement of our fundamentals, the extent to which it is reflected. But the signals are increasingly indicating that this is the improvement of our fundamentals. This reduction is more stable, that is, those signals are strengthening. On the right hand side is the international investors' behavior towards our drum denominated notes. It's historically high, their weight about 10%. And if we look at what's been done here, it's the ENBI Emerging Markets Bond Index. It's the average spread. Ours against their non-risk. This is the COVID, Russian-Ukrainian conflict, and the Iran-Israel beginning of Iran-Israel, what was the impact on our spreads of this conflict? You see that in previous similar conflicts, we usually were responding on par with the other developing countries, gradually getting back to the initial. Now the situation differs. In the right-hand chart, we were fully in tune with the trends of developing economies. Then the developing economies restored and are slightly lower than the previous situation. We kept going down, and at this point we are below by 40 base points than at the beginning of the conflict. This is the scenarios that our neutral rate may be much lower than the markets assess our financial markets. Coming to economic growth, in our economy, I'm certain you all know in Q1 the economic growth has weakened after the high economic growth in the previous quarters. Essentially, our economic growth has high volatility that needs also to be factored in, but in general it remains quite high if we look at the average growth, and in Q1 the growth was clearly impacted by several one-off factors. In the right-hand chart, for example, the financial sector's contribution has been negative to the economic growth, but that was only certain parts of the financial sector affected this, and it's not general and ubiquitous, and if it's temporary we will witness its restoration. The economic growth is pretty high and stays in the Republic of Armenia in general. In April it was around 7% economic activity growth, and by sectoral breakdown it continues to be distributed. In the processing industry developments, there were quite a few risks. We have reflected on them in the past. The Middle Eastern developments, for example, which had impact on small but important sectors. The tobacco, for example, in the processing, there is an impact on in the right hand side. In March, April, tobacco was minus 25, minus 8 year over year. But with respect to other sectors, there were stable growth observed. Another risk that was added to the total is the following. In some directions, the low diversification of our exports creates certain problems for us. If we have certain problems along several export dimensions, that vulnerability is reflected. Within the recent period, there were our export issues towards Russia. They made more stringent their import requirements. We encounter certain challenges here in the left-hand chart. It's our vulnerability. Only commodities exports to Russia goods contribute to about 6% of our GDP. And if we look at the right-hand side, certain commodity groups have quite a big share of exports to Russia, so the impact over several sectors could be quite significant, affecting the formation of revenue, and it may also affect the demand environment. On the other hand, our economic activity is still mostly determined by expanding demand-driven sectors. Mostly construction and services are the main drivers of economic growth. We've tried to single out subsectors in the services, the subsectors that are mostly driven by internal demand, and those that are more sensitive to external demand developments. So we see in the recent months the sectors driven by external demand also started to get active. In general, these discussions may attest to the existence of also other signals that indicate existence of high levels of demand in our economy, and there are factors that may also contribute to demand conditions being even higher than the expectations. In particular, if we look at lending indicators, especially consumer loans, this may result in that. This may reflect the high demand in the economy. The terms of lending have also slackened a bit recently. There is another impulse from there. Weakening of terms of, if we look at retail imports indicators of the recent months, these also come to prove the formation of higher demand. On the other hand, in the real estate market, if we look at the developments there, on the left-hand side essentially is the central bank statistic department, the index of residential real estate, which indicates acceleration within the recent months, and on the right hand side it's the cadastre estimates, which indicate that especially in Yerevan, it is the right hand chart, the gray caption. The gray bars show month-on-month growth, and we see growth, and the residential real estate prices are accelerating, reflecting the demand. Like I said, there are factors, especially about external demand driven growth, that could also contribute to expansion. In particular, tourist flows within the recent months, they've been pretty well galvanized. Incoming visits, which mostly are determined by Russian tourists. Flow growth in the right hand chart is the monthly data about Russian incoming tourists. Within the last 3 months, March to April, it's been year-on-year 40 to 60% growth. This may be determined by Middle East, Near Eastern developments. If you may remember, we talked about the uncertainty being high there. There are, bluntly speaking, B-type scenarios, but there's also A-type. We see that the scenario materializes which mostly because of constriction of the Near Eastern dimension, UAE, Egypt. Some of the Russian tourists prefer to replace that with the Armenian destination, but scenarios and prospects here continue to have high uncertainty. We'll see how the situation develops. Apart from the Russian tourists, the geography of sources also expands from various directions. We observe growth as well. So maybe this will be stable flows. About fiscal policy, we need to state that collection of tax revenue is at pretty good rates. Within the first 5 months, there is certain overperformance of revenue collection. This is maybe because the economic activity is higher than expected. or also inflation and expectation. Inflation is higher than expectation. Administration might have an impact, but expenditure-wise, there, especially capex, is underperformed quite deeply over the trends of preceding years. But the current expenses seem to be slightly faster than the previous year's proportions. The risk map hasn't changed since our last meeting. The scenarios are here. We discussed them last time. One thing that may change here is that maybe there will be an increase if it materializes, especially certain main directions of exports. If the issues persist there may be a need for the government to mete out additional support, and if this support is high in volume, it may have we may have more expenditures or and the resulting deficit. Considering the fiscal policy space being more relatively restricting, this may somewhat impact our risk premium. On the other hand, as you noticed, I was presenting the factors and signals that may have indicated higher demand expansion than expected. But on the other hand, if we look at the development in the labor market, for example, unemployment level is stabilizing 12-13% is it stabilizing around. On the other hand, the wage growth rates weaken and set at more stable or even below stable levels. Maybe these developments in the labor market attest to a more balanced position in the economy. So the uncertainty about the position of the economy, of course, naturally exists, stays, and both directions of scenarios are still valid. As for the inflation in May over April, the 12-month inflation has gone somewhat down, 5.3 in April, turned in 4.2 in May. But this reduction of inflation was exclusively contributed to by seasonal goods, the developments in fruits and vegetables. It's a seasonal development, and there were falls in prices much deeper than the previous years. On the other hand, we have certain risks, especially in seasonal goods. There are deeper falls in prices experience. I am referring to our exports towards Russia that encountered problems. In the left-hand chart, if you look at it, the left columns bars represent the consumption in the domestic market, physical volumes. It's imports plus the non-exported part of the product, and the right bars reflect our exports of the same goods, which also have two components. The dark blue bar is exports to Russia. The light blue is exports to other countries. So notwithstanding the impact of certain export restrictions on agricultural produce exist, they do not have a significant weight in the domestic consumption, with the exception. The second is peated fruit, apricot, cherries, and similar fruits. Here we have more dependent on the domestic consumption, because exports are about 30% of domestic consumption, and tomatoes are in the same situation. For the rest of the agricultural produce, the impact is less. On the right hand side, it's the flowers that this indicator is higher, but it's mostly agricultural produce. If we look at the right hand chart, when we're attempting chart where we're tracking current developments with the developments of within the last several weeks, we see that berries and tomatoes, we have a slight, compared to seasonal, we have somewhat deeper fall in prices, but we do not see much deeper falls against the seasonal. So if those restrictions continue to stay in place, and embarking on other markets becomes difficult, it's 5.6% of impact on total inflation, we assess. On the other hand, if we look at the development of general inflation environment, our core inflation stays high, and in May it was 5.1% level already. I have to say two things. The natural inflation also has a great weight of food and fuel in it. If we purge them from natural inflation, it's the gray, then we get 1 or 2% of inflation net of the momentum. In the right, in the left hand, it's year on year 2.6, and it's annualized quarterly over quarterly. And even if we look at the trend, it's weakened within the recent months. Q over Q annualized, it's about 3.9%, whereas a few months ago it was 5% or around. But we have to be cautious here, naturally, because it's the index of non-exported sticky prices. Q over Q has weakened over the last month, but it's still high, which essentially is a matter of concern. On the other hand, if we look at which are the main drivers of inflation going upwards, it's mostly food. And one has to say that it's mostly meat, dairies, and bread that contribute to the formation of high inflation. Although we may say that they're usually more of a supply factor driven, but on the other hand, when we look at it becoming more widespread by the commodity groups, maybe this also attests to certain demand factor expansion in the inflationary development. On the other hand, the index of non-exported sticky prices, which has an important place in our discussions, has grown somewhat, still setting around the 3.4% target level, which is significantly contributed to by the health services inflation within the last month, in turn determined by the universal insurance deployment. In the left chart, it's 5.7%, health services inflation, but its monthly growth in January, February, March, it's the red bars on the left hand. It was 1.2, 3.4, 0.8 monthly. In April, May, it's zero monthly inflation. So maybe there were adjustments taking place, but the risks still naturally persist here. On the other hand, if we look at the total wages developments that seem to stabilize, as well as the non-imported sticky prices index that has somewhat grown, but it's still around the target levels, as well as our direct surveys in the public, they all come to attest to inflationary expectations gradually stabilizing around the target level. As for the initial conditions in the economy, if we compare it with the previous quarter, our signals from the participants in the financial market is that they have assigned greater weight to the demand conditions in the economy, which is in tune with the overall developments of the inflationary environment and other factors. But there are, like I already mentioned, factors here that may prove that the demand is higher than the estimates, and there are factors that may attest to it being lower, and there are many factors that will have a long-term expansionary impact. So in a nutshell, we're in a small positive area, 0.6%, and the real exchange rate position also uncertainty persists here. In the past there were lengthy deliberations we've had. There is an uncertainty about the trend as to how fundamental were the recent years' developments, whether production and export capacities, maybe the trend is higher than the market assessment. But the uncertainty here persists. The market participants about the nominal exchange rate expect gradual devaluation over the forthcoming 3 years in comparison over the previous quarter. The curve is at a lower level. It's more appreciated exchange rate. The multiple factors we discussed previously may also indicate that perhaps our monetary conditions, policy conditions are closer to neutral, maybe slightly more constricting position of monetary conditions, but the uncertainty about the neutral rate is still quite high, and this uncertainty pertains to every component, essentially. Like in the US, there is uncertainty high about the neutral rate. The trend evaluation, uncertainty about it is pretty high, and the long-term sustainable level of risk premium and inflationary expectations is high. Uncertainty is pretty high here, which is why on the left-hand side you will see a big spread of uncertainty. About the market expectations, if we'll reflect on these, the market expectations are about the same along these dimensions. The markets expect that the economic growth at this point is slightly higher than the long-term stable level, but it will gradually stabilize over those levels, and the inflation in its turn will be mostly determined by supply factors, although in our surveys we clearly see that some of the respondents also identified demand factors in the formation of the behavior, but it's mostly the supply factors prevailing in the expectations, and the inflation will continue to go down, setting at the target level or around it. We expect the policy to go down much more gradually. 0.25 over the step will be the policy rate will go towards 6.25 over the 3 years, but the steps of reduction will take place later. That's the expectation, in which case the exchange rate will devalue slightly. And the current queries, the short questionnaires that we do before and after the decision, they indicate a one-step reduction in tune with the expectation. If I compare this short survey with the previous short survey in the wake of the previous decision, the market expectations were that 0.25 reduction should have taken place slightly earlier, but not within this year. Next year, if we look at the yield curve developments, the curve, we didn't see any shifts within the recent period. The yield generated policy rate expectations are also in tune with our questionnaire surveys. They indicate 20-25 base points reduction expectations. If we turn to scenarios, we of course publish all this for your perusal. I'll try to go through it fast, but if you have questions, we'll answer them with pleasure. I'll break down our scenarios into several components that the board has discussed over this quarter and which had a serious role in the decision making. The A-type scenarios, first and foremost, these are the ones that are about the expansion of demand and the uncertainty about the neutral rate is covered in these scenarios. It's pertaining to the uncertainty about the US neutral rate, its subsequent growth, which may also affect our neutral rate, as well as when I reflected on that in the monetary policy development, if there is a need to offer support to some economic agents, considering the monetary restrictive position may contribute to the increase in countries' risk premium. On the other hand, there is a scenario about uncertainties. This is A-type scenario, which I will submit to you at greater length.
As for the inflation, that has specifically been taken into account, given the circumstances that inflation is especially high in the so-called primary necessity goods or commodities and the salient goods that might be having more asymmetric impact on expectation. The other group of scenarios is about uncertainties and specifically regarding the demands to the national economy. Specifically, the factors I just conversed about are quite significant. Most of them might assert of a higher demand in the economy or further expansion thereof. On the other hand, the fiscal policy might be exposed to bigger risks in terms of policy development that might contribute to increased demand Events in the Middle East might come into the play, specifically growth of tourism, as a scenario that can persist with certain uncertainties. And the next, specifically related to the interest rates, and that's high liquidity in the banking system and high income, high profit specifically might result in further weakening of the or extenuation of the terms for the loans, and several scenarios that might be related to capital flow towards Armenia. As you may know, there is significant capital inflow to Armenia, contributing to loan policies, of course, and to creation of demand. And there are several scenarios that some of the board members are concerned with, specifically regarding Russia-Ukraine conflict, further extension and uncertainties in Russia regarding the future, and further strengthening of the tax policy and aggravation in the business environment, access to the internet, etc. So, I mean, certain factors might contribute to outflow of capital from Russia and also towards Armenia. Maybe not only capital, but also people. And in this scenario, there are global imbalances in the world, in the leading economies specifically, that have resulted in a better sentiment towards the developing countries. And if this persists, capital flows towards Armenia might grow. There is another scenario regarding certain uncertainties gravitating around Armenian security situation, specifically related to improvement of security conditions. And in this regard, yes, the opening of the communications and similar processes might result in capital inflows. So next is in fact related to the supply. So specifically, if the conflict in the Middle East lasts longer, uncertainty, tension, or certain resolutions or extenuation of tensions might contribute to incremental growth of supply, and rates remain the same in prices, so there might be certain inflation growing in Armenia. We are more inclined to look at the B-type scenarios, specifically with extenuation of demand on the global market, in the global economy. As I just said, this is a long persisting high level uncertainty, further drop of the sentiment among the consumers, and in the leading economies, specifically the US and China and EU, we're seeing currently some inclination, some proclivity towards extenuation with certain risks persisting. Next scenario related to the overprice financial assets in the United States, and possible noticeable adjustments there too, in which case not only in the US but also in the global economy the demand might drop. Next is uncertainty regarding the Russian markets, Russian economy, specifically in plummeting demand given the infrastructural issues that are currently created there, and might ultimately result in general change in the environment, worsening environment, and weaker demand. The other group of factors here related, first of all, to weaker demand in the local economy. I mean, developments on the labor market might come into the play, specifically when we look at separate components of inflation. They might assert of weaker terms for demand in our economy. And the other point is related to export to Russia, with the history of cooperation. So if issues related to export persist, in fact, in corresponding sectors, there will be less income. Some sectors are going to suffer inability to export towards Russia, and some of these issues I just mentioned might derive from there and then spread towards other branches of the economy. As for the neutral rate, well, we are looking into a scenario of a lower neutral rate, specifically related to sustainable risk overpayment, and specifically because of extenuation of official risk levels. As for the supply, there are more positive scenarios. One is still related to problems in the Russian economy, high uncertainty, and specifically given limiting factors pertaining to migration, because they gradually stricten the terms, and that might result in less migration towards Russia. Correspondingly, there will be more labor force in our economy, and the prices will drop. Next scenario related to export of agricultural produce, and not only. There are issues with exporting those towards Russia, and this scenario is specifically related to low prices. And there might be supply more than necessary in Armenia. And next is complete regulation or resolution of conflict in the Middle East, and a significant increase in the supply of oil. Some countries are looking into increasing their exporting capacity, and in this case we might be seeing plummeting prices and pressures emanating from there. As for the standard A and B scenarios, as I already said, A scenario is specifically related to the following. During the last quarters, we've been seeing high inflation in the primary commodities, and the inflation is here 8.6%. Cumulatively, for the last 8.5 years is, well, that acceleration comes from last year, second half specifically. We have about 15%. However, this scenario is relevant to the situation where the primary commodities, everyday commodities like vegetable oil or beef, eggs, bread, these are the goods people need every day. And usually, and literature also says that, there are the so-called salient goods that are more visible for others compared to the other goods. So growth of prices on those, in fact, impacts the expectations related to inflation much more significantly. And this issue was that expectations on inflation in the society might be exaggerated or accelerated because of the structural problems, because in terms of the monetary policy, it is in fact very important to manage price increase expectations effectively, looking into certain components of inflation and considering signals emanated therefrom, and we give significant importance to those signals through our monitoring. Because even if the general inflation is 2% or 3% over the target, but there are still certain structural matters in the process, then these signals are of significance for us in terms of effective policy implementation. So in this condition, in this situation, they have significantly contributed to increase, and essentially there might be a higher line here. A higher line required that you can see on the chart on the right. So to solve these issues, and there is an exercise that we just did. If you pay attention, I mean, this is the case where if the central bank loses or lost credibility in this process, then apparently we might need more acute policy response to resolve these issues. So naturally, the risks remain on the other side, and there are quite many. And one of those risks, I mean the B scenario that was selected randomly, presented to your attention, is related to the global demand and possible weakening, possible extenuation thereof. So as I just said, there is high level of uncertainty, high oil prices, and highly combustible, and that has significantly impacted the perceptions and the sentiment, the perceptions of the future, the expectations from the future. So we can see the manifestations thereof either in the PMIs or in the growth in other countries and some indicators. It's also very important to look at the sentiment. If you look at it either in the European Union or in the United States, it has significantly weakened, reaching historically low level, especially in the United States. So with further weakening of the demand, or in case of plummeting demand, even if this contains, well, I mean, if you consider oil and everything, even a short period of time, it might impact the inflation in the midterm, this way or another. The dropping of the global demand will have very negative impact on us, just in terms of environment, demanding lower level, lower threshold of policy rates than the markets expect. That's the chart on the right side, by the way. So here we have presented the standard A and B scenarios. This is it, apparently. I'm sure there are questions. Please, one by one, and introduce yourself before asking the question. Georg Nalbanzan, head of an investment company. Did you hear the name? I just want to know the next scenario for the next quarter, meaning does it factor the turmoil after elections, post-electoral unrests, or it's just a foreign environment? Okay, Mr. Nalbanzan. The two scenarios, well, naturally, they're not the ones. I mean, if this is policy-wise, framework-wise, and then Mr. Katoyan is going to present a discussion on the board. But these two scenarios are not just the two scenarios that the board had taken into account in its decision-making. They have been selected randomly. I mean, on both sides there was scenario B and scenario A, selected to enrich policy communication, at least in that logic. But the complete scenarios are on the table, and the members of the board discussed it And there was a decision made by the board. So when the decision was made, the risks emanating from those scenarios were taken into account. So these scenarios, meaning A and B type scenarios that have been here assessed, compared to other scenarios, do not have any advantage. Neither urgency, nor relevance policy-wise, nor impact policy-wise. Meaning, those are the main scenarios. In fact, everything that you just mentioned is about the potential source of risk. We think there are risks coming from different sources. If we try to consider what you just said, given the materialized risks, then the members of the board, when considering their own views, took into account those risks. Impact on demand, impact on fiscal policy, etc. However, in all the estimates, inflation-wise, the impact of those risks was not substantial. And there is a different circumstance supporting it. Usually, as a rule, a significant part of the source of that risk materializes before elections, before political events. I mean, the largest share. So we can say that everything that could have happened already happened before the electoral campaign. Everything that could have been expected, was materialized already, came forth, and was seen, hence insignificant, not noticeable. As for the future, I think any action, any event that could anyhow be linked to politics, like the possible response or reaction of Russia, with all of its projections and fallouts, any type of consequence exists in type A and type B risks. Now, in which vector the proclivity towards further endurance is something we're following currently. And in further decisions in terms of materialized risks, this will be taken into account. David Karapetyan, Evoca Bank. Thank you very much for the presentation, first of all. There are several questions, and I'll go one by one. First, coming to the point presented during the conference yesterday, specifically related to limitations on Armenian products in Russia and negative 2 percentage point impact on Armenian economy. Could you please clarify that part? Which sectors of our economy are going to fall under that negative influence or impact, and what would be the total share of that reduction in the Armenian economy? Have you taken into account the potential for releasing Armenian products to other markets? Like if Russia limits our products, then we could consider other markets like European Union. And what would be the impact thereof? And if that impact has been factored in, and even if not, is it realistic to have it factored in the nearest future? And with that restriction, apparently, we should be able to subdue and submit to that approach, since there are no alternatives. That's the first question. Next question. Related to energy carriers, prices are changing, prices for food are changing, and there is specific impact on the GDP. We're trying to understand if you have any assessment. There are changes, increase in the price of gas or wheat, because mostly the import is quite significant there. And if there are limitations, what would be the impact on our economy? What would be the alternatives to it? What would be the management mechanisms? How to rule out any deadlocks here. During your presentation, you partly answered my question. There are certain price-related policies approved by certain banks, specifically some factors related to increasing prices in the loan market, right? Some real estate activity and price distortion should have a role there as well, because in the price formation, price policy, the banks are not at their full discretion. They're not fully independent in deciding rates, and limitations do not contribute to adjustment of prices based on demand or supply, respectively. Rates will be changing just as long as the consumption loans go down or credits go down. That results in faster growth and higher inflation. I'm very sorry. What the limitations are? I mean, what limitations do you mean? How are the banks constrained in their decision making? I'm sorry. Well, according to the civil code, there are certain caps on the rates, right? I mean, if it's more than double of the estimate, then they cannot issue loans under such rate, etc., right? And certain restrictions in other sectors as well. But one of the significant ones was this one. And my last question: if, per the central bank, there is probability of the Russian scenario, meaning some negative economic impact because of restrictions Russia applies against Armenian products, there will be certain plummeting sectors. In that case, the high level of capital buffers should not be justified, meaning in this situation we should not be looking into keeping them this way. I mean the macro prudential buffers, because after their increase, never would they drop ever, because economy is also in the proclivity of growth, kind of warming up. But there is apparently a probable scenario of a negative impact. Thank you. And chilling. All right, I'll start. And if I skip any point raised, I'll ask Mr. Katayan to fill. So from the start, kind of, this is what I'd like to put forward. This discussion is about the monetary policy. I suggest not touching matters beyond the monetary policy or matters that are not directly related, specifically the macro-prudential thing. And the governor of the central bank holds a special press conference on financial stability and also micro-prudence, etc. I mean, you can ask your questions there. And that's a very effective platform for discussing these issues. But I can still refer to parts of that question, superficially, if you don't mind. Now, coming to the questions you raised initially. First of all, thank you very much for that question. And we essentially enjoyed the opportunity to make certain adjustments there as well. And after the press conference yesterday, I don't know how attentive you have been. There were certain articles in the media. In fact, what we had said had been misinterpreted. Interpreted in a way that under the impact of these factors, the GDP will drop 2%, which is wrong interpretation of our estimate. And we clearly spoke about that. I also spoke about that yesterday. So this is what our estimate is. It says that at this moment, for those products, especially agricultural products and products of processing industry, for which there are limitations in force in Russia, then if those limitations last long, and if these products do not find other markets, do not go anywhere, and by the way, there should be no production for us to see negatives there. But this is specifically about possible impact, negative impact on GDP in the range of 1.5 to 2%. Possible impact in the range of 1.5 to 2%. Negative impact. It's not about 2% drop of GDP. Let's be clear on this. Secondly, as for the potential to move these products to other markets, I have to tell you that for a small group of products, there have already been referrals towards European markets. Yes, certain products are already moving to Europe. Meanwhile, we have to take into account that standardization and compliance with European standards is a complicated process. It might need time. Meanwhile, with certain probability, such issues might fall out of certain processes, and we may need to speed up those processes. I mean, sometimes these problems, in fact, make certain processes faster, other processes. So, let's see how the situation develops, and such scenarios might come forth. And that's not only about the European market, but it's also about the Asian market and the Middle Eastern market and other markets. Because if you look at this chart, specifically for products, specifically for agricultural products, for which we have certain issues, maybe these are the seed produce. I mean, those that on the internal market enjoy a bigger demand. For the other products, this issue is much smaller. So maybe we even solve the problem by selling them on the local market. As for products that are exported extensively to Russia, specifically brandy and other products, for them we don't have problems at this moment, meaning our assessment, our estimate is related to those products that are under limitations already, and if we don't find alternatives, or if we don't sell them on the local market, or we don't have them used, then we are in fact going to say that 1.5 to 2% is more realistic. Next issue is related to fair pricing. Well, I should say, and if I'm not mistaken, that's regulated by the civil code. And if it's beyond our regulatory capacity, meaning that specific factor, then as an advocate of free market, I don't like limitations at all. So free price formation is always a consequence of very positive processes. Meanwhile, naturally, it solves a number of issues, and we should refrain from comments on whether it's right or wrong. Specifically, that's not for this meeting to discuss. I would refrain from any comments on that point. I hope I haven't missed anything, or if Mr. Ketoyan has anything to add, please. Well, a couple of points. Vazgen already said that that's the possible impact which has not yet been cleared here. There are certain factors that might come forward there. In case of the European Union, its licensing, its standards, its logistics, etc. But as far as I know, for the first month and for the same period last year, we have increase in export by about 90%. Well, of course, it's a matter of low base, etc., but we have the potential. And you asked about energy carriers. In terms of energy carriers, we have it in our scenario among the risks. Yes, there is a potential risk and there are more simplified mechanisms to import fuel, and possible limitations create risks that are under A type. But currently there is a prerequisite to it, and it's hard to assess the impact. Since we're looking into other routes, and I think that it is possible to apply additional scenarios here. As regards the other issue, in case of plummeting, we can say that there are threats to demand, to reducing demand, and we had to know how harmonized the policy is or was in that regard. So the risks emanating from the Russian vector are two types. There are both A and B type risks, but at the same time there are risks that are A type and end up in a capital inflow, which is in fact contributing to demand. And we have to take into account that in terms of promotion of inner demand, there are other factors. So if we focus only on factors that contain the risk of constraint, then that demand would be distorted. But there are also factors promoting demand, and I also said the capital inflow, the inflow of tourists, etc. Also the construction sector is a serious factor, and in result we think, the board thinks, that we can also speak about balance in A and B type risks, and the response of policy decisions on the rates are among the balance in different factors, the balances of different factors, based on our opinion. Now, as per the vector of further materializing, then based on that the board will make the respective decision. However, these risks have been taken into account, have to be taken into account. We have to know that there are also counter risks to these risks, and we have looked into the general picture. I'll respond if you don't mind. As regards fair pricing, it would truly be desirable to know if there has ever been such assessment. To know that in this situation, because of that, because of limitation on pricing, the inflation has been impacted this much. Provisionally, if at this moment banks conduct an assessment and see that there are more risks on the consumer market and they have to manage those by rates, interest rates, but they cannot, what would be the impact on inflation? Would have been the impact? Say the real rate, how much should it be or should it have been for the central bank's expectations to come forth? Or the growth would be over the expectations, or there was no impact on the mortgage. Okay, to just clarify what you're saying, to simplify. So you're saying that there is a person who wants a loan And we do the assessment and we say that this is a 26% risk customer, but we are limited to 24%. We'll give it 24%. So we, in fact, make a positive decision for that person, right? 2%. Because I don't understand. If he's a 30% customer, what would it be 24? The logic is that you should not give him a loan at all, right? Isn't that the reasonable approach? That in such a situation you would refrain from issuing a loan to that person. He would have been denied and go and find other sources. Would you clarify that, please? Okay, in the case you just mentioned, when you assess the creditability of a person, in case of 26%, he might not be creditable, bankable, but in case of 24, he could, meaning his his ability to pay 24% is there, but is not if it's 26%. But the risks are not calculated that way. They are portfolio risks, and banks manage their risks in portfolios. Now, if the bank announces that it would provide 20% loan, and there are clear principles of creditability assessment, etc., if in that situation, the one who suffices the 20% risk or loan, would not say no, because in the situation you just presented, the bank would refrain from issuing a loan. But if the bank could increase the rate and offer 26, because that's what the risk is, this person couldn't have been pronounced creditable, meaning the risk that the bank, that portion of the risk, 6%, 4%, 2%, is taken by the bank. It's the bank's margin of appreciation. It's their yield and might be further compensated from a different source. Now, if in the loans these risks are accumulated and not compensated, they might be compensated from a different source. In case of, payments by intermediaries or deposits. Banks sometimes do not want to change the rate because there might be issues of liquidity. Are there any other directions? Improve the scoring model and be based on real risk. Meaning you're saying, like, if it's 20%, then you will have to issue a loan. But if you think that their risk assessment says that there shall be 26%, then what's the problem? You can build your scoring model in a way so that it takes into account the additional parameters also, which will allow providing a real assessment of the potential borrower. So I see a problem in the model in terms of assessing creditability. You might need to improve that system. No, this is not about the real assessment. The bank sees the real assessment. It knows that such borrowers, to compensate the risk of these creditors, there is a price. Meanwhile, it is limited to a certain point. Okay, if this is a proportional model, then in fact you're saying that we should pay a smaller rate, right? Okay, then maybe no rate at all. Then you're losing your market, in fact, and you acquire stability. It's a dilemma. So if price formation or price policies were the same in the whole system, there would be no problems, but apparently they are not the same. Okay, so you're saying where you should draw the line. Wherever you draw the line, there will be potential consumers. that will be drawn down by the market. The US faced that same problem. They solved the problem on their own. What happened in 2007, 2008, you know very well. Now, you are drawing that line right now. The central bank decided that that's where the line is going to be drawn. And that's kind of a stability factor. If the bank thinks that that line is lower than it had to be, then we can discuss. We can consider arguments, better justified explanations. We can discuss it. One more, if you don't mind, and we'll move forward. David, in fact, gave us a great example, stating that this is how it works in case of free competition. That the rates are lower when when there is fair competition, right? But if the inflation comes from those distortions, it's not the consequence of impacts. They are not significant, even if there are impacts. Please, Mr. Frangen. Thank you, Vazgenjan, for a comprehensive presentation. My question is about the economic growth. Very inconsistent information based on different indicators. One is for the first quarter, 7.1%. Second quarter is the GDP with more modest 4%. Specifically, the growth in the private consumption has grown significantly. And at the same time, we see growth in loans, in credits. I mean, there are kind of inconsistent, conflicting data, and I'm trying to understand how the central bank navigates in this data, how it assesses the current position of the economy. Which are the indicators that, in your opinion, are more trustworthy? And if you have an analysis for the GDP difference, then what is that analysis based on? Okay, Ignati, thank you very much. That's also a significant source of uncertainty. And the beauty of our framework is that there is uncertainty everywhere. And even in the official data, there is uncertainty. You know, when you look at the economic activity index, and we see a high activity index, when you look into sectoral developments in different sectors of the economy, I mean, and the inflation there, the general picture is that the economy is highly active. Now, as for the indicator of economic growth, there was only negative contribution to the growth from the financial sector. Well, we've been recently saying that after big leaps in growth, we would be inclined to more stable growth. But if you look at the developments on the financial market, then the picture is the following. The banks that have a big share in the financial part of it, and that's over 80% of the added value by the banks, there is small but positive growth, meaning there's been significant contribution from other branches of the financial sector, and our assumption is the following. We work with some of our colleagues to understand better, but the hypothesis here is that the other sectors are up to pension funds and cumulative funds. The assumption here is the following, that when there is a reassessment of assets in March, because there were significant plummets in prices, maybe reassessment resulted in loss, and that loss is expressed. However, we're still looking into this, because, I mean, if you look at the general situation, then we have that issue, we have that situation as well. And if you were attentive, we had that in our report. There was a question in our report on how accurate would the economic growth in fact reflect on the real situation of the economy. Aikas Vanyan, Maltex Consulting. My question is related to possible predictions, estimates of economic growth. Well, I'm also inclined to think that it's related to the financial sector. If you look at all the developments in the financial sector, in the coming months, in the coming quarters, there has been significant developments in supply. One is for the export of services. Next is for export of gold. I mean Lydia and Armenia. Any estimates here? Are you planning to conduct any studies to check what impact it might have in the coming years? Yes, thank you. Aikas Jan for the question. Yes, we have certain estimates there as well. For AI, it's quite challenging, I should say. Conducting those calculations is very challenging because we are in fact facing a completely new reality. It's not only us, but the whole world. In fact, either in the value added and how we're going to tackle that, I should say there's more impact on power consumption. Well, at least that's how it's going to look in the nearest future. Because investments are quite significant, but the import is significant too, because most of that investment, will be imported chips and microchips. So we're still quite discreet in speaking about that, but as regards exporting gold, and specifically the factor of Lydia and Armenia, I should say that there is quite a lot of uncertainty on the start of their operation. We don't know, because general assessment is the following: either by the end of this year, or there are expectations they might even move to next year to start the operation. We'll see. However, the volume announced and put into the estimate allows us to say 1.5 to 2% positive impact on our economy at the point where they start exporting gold. It's not of significance. That's going to be the growth and the impact on growth, 1.5 to 2%, but there is significant uncertainty here on when the operation of Lydian starts and with what capacity, what magnitude. Just a short observation here with the previous question as well. In fact, yes, we always have these issues with data and decision making based on data, but we're trying to combine that data with other data, trying to see how consistent it is or they are. For example, we need to know whether we should speak about additional demand if the economy grows with the same pace. But on the other hand, if we do not establish the same growth in payroll, then that's a signal. That's a signal that the economic growth should be materialized in the logic that there is significant improvement of demand that might result in persisting pressures, etc. So it's more a restricting factor. The same for Mr. Fanyan's statement. Like if you look at the payroll, as I said, there is moderate growth here on the one hand. On the other, there are structural disproportionalities, like AI factories, incomparable to other sectors of economy. There are structural disproportions here, like if we consider Firebird, for example. Firebird, which is one of the implementing agencies, is an active player on the market, the labor market, and it involves corresponding experts with very high salaries, and that has resulted in significant growth of salaries in this sector, which we have not been observing in other vectors of our economy. So at this moment, we can see the prerequisites, the signals, but they're not enough to decide what direct or indirect impact is going to be. There is one response. Can I respond? Well, for Firebird, frankly, it was surprising because I thought that even if the salaries were high, the number of staff is very limited. Like if you look at their income and the value added per employee, then it's going to be incomparably higher than in many other companies in Armenia. But since the quantity is limited, there will be no significant disruptions on the market. There will be 200 to 300 people per the official data. Part of them are going to be just guards, not qualified personnel. So if there's any information that there will be more, much better then. The point that you just mentioned, decision-making wise, is structural, meaning we're looking into structural proportionality. We're looking into violations in that proportion. So naturally, the example that you just gave, the one that we're currently discussing, is pertaining to the risk of potential structural disproportion, right? That's the risk from which we're looking at it. It's not yet a materialized reality, so the scale is not significant yet. Hence, at this moment, in the decisions we make, we cannot absorb that fully, but we just look at that as a potential source of risk. Other questions, please? Edgar Agabekyan, Rock Capital Investment Company. We discussed expectations of the market players and inflation and expectations on it. Would you please give more details on whether you see any deviations there, meaning expectations among the players of the labor market, and also in terms of your policy and in terms of the service held among consumers? Do they look alike, and are there deviations? And do you see any deviations regarding rates on the market or behavior of the market participants? Thanks for the question. Mr. Agabekyan, the issue is the following. The survey held in an extensive number of respondents is of quality modality. This is the chart on the left. So the question is formulated in a way that it is like, what do you think? Will the prices be growing in low, medium, or high pace? So we're getting quality out of the information to make quality inferences out of it. There are 2 points I'd like to underline, specifically related to the service held in the last quarter. The gray line is uncertainty. This is the curve showing answers we don't know. Those who said that they expect low or slow growth of prices, they are in the darker blue or on the darker blue curve, and in yellow, this is the very high pace of price growth expected. So we see a group of surveyed citizens which is in fact, in its specific weight, smaller than the group of citizens who think that the growth will be slow. That's both due to reduction of the uncertain respondents. Yes, the high pace expecting citizens number has dropped. The slow pace price growing expectation has grown in the number of respondents. To conclude on that part, I have to say, even if we are not able to do quantitative comparison, if we try to look at these signals qualitatively, then one should say financial markets also expect that essentially the general picture at this moment is the following. Markets think that even if the price is higher now, higher than the target, then the supply factors should be prevailing, and the markets are waiting that with their fading, the inflation will drop and get around 3% as the target. So signals from both sides might mean that inflation expectations continue to stabilize. Now, as regarding the pricing on the financial markets, if you look at the developments of the profitability curve, then we don't see any materialization of expectation on inflation. Well, something might be there, but we don't see any things that and any factors that would make it go faster in terms of change of the curve or long-term change. We don't see any significant shifts there. Please. Good afternoon. Fast Bank, Dealing Service Head. Christina Gasper, thank you for comprehensive presentation. The question is there an estimate related to salary growth in Russia? Maybe one of the factors is because labor force flows towards other markets, including Armenia. And if yes, do we have any assessment of what consequences it had on our market? Thank you. Thank you for the question. You see, as we spoke for the Russian market, we can notice that, yes, there is increase in real salaries. The nominal as well, and it's extensively distributed by branches of economic activity. We do the assessment this way. There are no specific concentrations here, so it could be one, two, or other factors. I mean, it's not consequence of those factors. One of the factors which is more promoting, when we say that the results of fiscal policies could be well expressed in different sectors, one of the most important factors when looking at the surveys held among businesses in Russia, as well as restrictions on their operations, one of the most significant issues for them is insufficient labor force. So, without even trying to dwell on details here, apparently it has certain impact, and they speak about that, but we don't have data. So, there is drain of labor force to other countries, and also military mobilization that absorbs significant resources to further aggravate the labor force related situation. And in these circumstances, it might have significant impact on the economy in general. On the other side, well, we've been seeing inflow of Russian citizens to Armenia. It's not only tourists, but those who have come to Armenia but have not yet left Armenia. We'll continue following that trend. We might produce a general assessment on how popular that policy is. We don't have any assessment of outflow of Russian population towards other countries. There is another important circumstance here, policy related. First of all, sectoral disproportion. Certain sectors related to military industry are at the peak of productivity. Even with the high salaries, it's very difficult for them to find sufficient labor force, and they have a problem. On the other hand, reduction of demand because of the sanctions for non-military sector results in significant impact. Sometimes it's not clearly expressed. There is latent unemployment when people work not for a full week, and there is a significant number of sectors under this, so it's very difficult to conduct an assessment here. As for the impact on our market, on the one hand, this could have resulted in growth of real salary and could become a prerequisite of outflow from Russia to Armenia, but given the inconsistent confrontational processes that exist in Russia regarding the changes in the legislation on migrants with certain limitations, this is going to be a serious barrier. Policy-wise, the way we have put this in our expectations is different. So there are two scenarios. We have considered both scenarios, both risks, and we think members of the board clearly see that because of insufficient demand on the labor market, we are going to have limitations of labor force. And there are limitations on involvement, and that is specifically going to create additional pressure on supply on our labor market, and also change the risk estimates. So this factor is of significance. Thank you. Other questions? No questions. Thank you, everyone.